Well, it's Friday, ladies and gentlemen, and we've got Jason Witten on the road to nowhere at the moment, and luckily we've got a substantially better looking personality to bring in, which we promised last week, Paul Sidorovsky from Sidcore. So, mate, welcome to Wealth, Wine and Wisdom. For those who are first time into the channel, and there's a few of you who are jumping on already, please give us a shout out when you come in. And I'm navigating this at the moment, not Jason, so I'm buggered if I know if I'll do as good a job as the great man himself. But I'm going to do my best to try and see what's going on in the chat and bring you across. So, James, good to see you, mate. Thanks for hollering out. But for those of you first-time listeners, Jason and Andy, and today with a special guest, accounting extraordinaire, Paul Sidorovsky, the only accountant with a personality, allegedly.
Only one we've met anyway, Andy.
That's right. But so Wealth, Wine and Wisdom started in the middle of COVID, or when COVID first started off, and Jason and I were debriefing on the weeks. Jason from 20 plus years in residential property investing in Australia, here, New Zealand, over 5,000 client experiences with the company at whole. If there's something that's worth knowing about property, it's inside Jason's brain, and we spend it weekly trying to tease that information out for all of you. And myself, banking, finance, corporate and investment banking don't hold it against me for the last 20, 25 years domestically and abroad. So we came together to chat about all of the changes that were happening in financial markets, in legislation, to help our small to medium business owner compadres navigate what has been an ever-changing and complex world. And as we promised last week, we started talking a little bit about the budget, but you know that we're very, very big believers of what you keep in your pocket is one of the most important things. And that's why we brought Paul on tonight to chat about, a bit about the budget and a lot about, tax planning, small to medium business, and just have a little bit of a chat about the landscape that we're in right now, given everything that's going on, especially for small to medium business owners. Because as Paul says, Jason says, and I do as well, it's not about what you make, it's about what you keep. You can all boast about revenue as much as you bloody want, but it ends up in that bank account or in the wealth account for you. And so I think, mate, I know you've got to dart out at some point in the not too distant future. You've got a big team event that you've got to grace your presence and buoyancy with. But mate, if you're able to sort of share your insights into the world as we see it now, from a tax, a mid-COVID world and post-budget, pre-tax position for our property investors and business owners, mate, I'd love to just wax lyrical and pick your brain a little bit, if that's all right.
Mate, yeah, look, absolutely. Look, the budget came out, and we've all seen so much info and data around the budget that we all get sent around. But look, like any other year, probably the doozers that I love, and you probably know, Andy, you got your basic ones, prepaying expenses, making sure that you pay your super before 30 June for contributions that are for that month or that quarter before 30 June. Big ones for me, stock write-off. If you've got stock that hasn't been moving for 6 months, value it down to nil. Write off bad debts, debtors that aren't looking likely to pay. They're like really basic ones. With COVID and the government and the budget, they've brought out that, the right asset write-off. That's been extended. So just to give you a quick heads up, new or secondhand, unlimited dollar value that you buy before 30 June, you get the write-off, other than a motor vehicle, because it's capped to the depreciation cost limit around 59K. So they're the main ones, Andy, that I see. Personal super contributions, again, depending on your age and where you are, getting that tax deduction before it. Deferring billing, if your cash flow permits, don't invoice everything out before 30 June. Make sure any invoices that you have put out that are unearned income that's for the future, then make sure you pick it up as a liability and not as income. Okay, so unearned income. What else? The other ones that I've got. Prepaying rent and super. We put that on. Prepaying interest. Just bringing expenses forward where you can that you know you're going to spend later on. The other one too, you can write off the value of your written down value of assets at 30 June. So just make sure your accounts don't miss that one. It's a massive one. So just make sure written down value of your assets at 30 June get written off. It's quite extraordinary. So yeah, they're the prepayments ones, Andy. And any questions, mate? Any questions on that?
Well, mate, I think that one of the things is interesting, and I'm glad you touched on it, is because a lot of people remember, and I don't know why, but a lot of people remember the 150 instant asset write-off. And I hear a lot of people going, I can claim up to 150, but that's not the case, is it? It's you can claim as much as you want, pretty much.
Since they announced it, so don't hold me to the date, but let's say October or November last year, it's unlimited. So from then on, it's unlimited up to 2023. Like I said, other than motor vehicles, okay? Like motor vehicles that have the cost limit on them, you're capped.
So we can't go out and buy
the luxury car tax, Paul? Is that luxury car tax limit, or is that a different limit?
Depreciation cost limit.
Okay.
Yeah. So you can't go out, Jason, get that Porsche and claim it before 30 June, buddy. You might be in the Porsche already, so you're too late. And
I am actually, but I'm too late to claim it.
All right, you've pegged him 100%, mate. He'll be driving down there in the Porsche as we speak. So, mate, it's only up to 60 or close to 60,000. You can claim of that sucker if you bought it new. But here's the thing, Paul. Have you seen any of your clients actually dumping old cars and maybe buying them a little bit newer, or in order to bring that instant asset write-off further closer to them? Because
mate,
I've been considering. I'm kind of like, well, do I get rid of the nice car and give that to my partner and then get myself a nice little 59,860, whatever the dollar is, and just write it off in the first year.
The number's about 63 because of GST, 63, 64 because you get back the GST. But mate, absolutely, it's happening, and that's why we've got a shortage of cars. This asset write-off has brought car purchases, not only people sitting at home not traveling, but it's actually brought a lot of purchases forward. People are rewarding themselves because they're not traveling where they would have traveled before. They're buying cars. So it's a big one. But where the real benefit is, look, I'm seeing clients that are buying machinery for work that they were going to buy anyway, and they're writing them off. But the thing to be aware, if you're going to finance stuff and you get the write-offs now, it'll come back to bite you later. You just got to be ready because you won't have the tax deduction next year, but you're going to have the payments still to do. So as long as you're smart with the money, you don't go and blow it. But, if you're smart and you're listening to Jason, I'm sure Jace has been spruiking about the property market and what's going to happen for the next period. I haven't spoken to Jace about it, so I'd love to go and pitch with him on what we think the property market's doing and where it's going. Because I love me property. I do quite a bit in that space, so I'd love to catch and pitch on that as well.
Yeah, well, I think we got some interesting times ahead. That's for sure.
Jason hasn't been spruiking too much on it. He's literally just been playing the recordings from one of the first Wealth, Wine and Wisdoms that you were on, when he was saying, don't buy into this bullshit that it's going down. This is going up. This is going up. This is going up. This is going up. So he just keeps on replaying that. And I've got a funny feeling we're going to keep hearing the same video time and time again for maybe the next 2 to 3 years. So I might just pause there, mate, because I know that you got short on time, and for those, and it really is, it's a time scarcity thing, and we're grateful for you to jump on here. But Paul's also agreed for Jace, for yours and my private clients to jump on and do a good, really solid tax brief, really go through the nuts and bolts of
that'd be great,
the depreciation, all of those sorts of things, which are really key. And ultimately, the less you pay in tax and the more you can keep productively in your pocket, And that's the key, and not fall into that mistake, which Paul just talked about, that you buy $1 million worth of machinery, you finance the whole damn thing. Yes, you get $1 million deduction this year, but you've got $1 million worth of future income that you're going to have to pay tax on. And it's a big trap. So for those of you who are interested in finding out more, make sure that you're on Jason and our list so that you can come on and listen to the updates.
The other one too, boys, just, it's something that's been more topical of late. You've got the company tax rate that's fallen, 26% for this year, 25% from 1 July. Just be aware, guys, when you've got a trading, let's say you've got a trust that's trading, and you've got, the profits have got to be distributed out to beneficiaries, mums, dads, and a corporate beneficiary. The tax rate's 25% going forward for that when it's a business up here. When it's not a business and it's passive, it's 30%. So just be aware of that. Now, you might say, what's the difference other than the tax now? If you sit the money in the company, so you make a profit up here of $1 million and you distribute it out to the corporate beneficiary, the company, and you leave the money there, no problem. But 99% of the time, everyone rips the money out. So all you're doing is just, you're paying the 25% as opposed to 30%, but it's just deferring. It's just deferring more down the track, because you're still going to have to pay the top-up tax between the marginal tax rate and that corporate tax rate. Look, it's just something that's been topical of late. When it's trading profits, you can get your 25% tax rate. When it's not passive income, it's 30%. So that's
down the road a bit.
Structure is very important.
Yeah, and I've got a quick question for you, Paul, on that. Going back to the write-offs, a lot of property investors, property owners getting right into, we can't go over holidays, can't go overseas, we'll buy a car. Well, maybe we can't go overseas, we'll renovate the house, we'll renovate an investment property, we'll put some money back in. Could, speak to that for 5 seconds about coming up the end of the year, be careful about, capital versus repairs?
Mate, I'll give you one even better. So if you're just going to go and repair your house or renovate it or do whatever, and if you haven't got a depreciation report, get one before and then get one after, because you get to write off all the stuff that was there before you did the renos, because they're all gone. And then it's a double whammy. So that's number one. Yes, repairs versus capital. Make sure the efficiency of the function. This is what the ATO says. If you replace flooring with same flooring, not heated tiles or whatever, it's not a capital improvement. It's just a repair. So, you can't do this if you buy a property and repair it up front. That's all capital. But again, you can claim it if you get that depreciation report before. Big one. You bought a property this year and you renovated it, make sure you got 2 reports. Just remember that. You've got to get 2 reports.
That's a good one. That's that scrapping law, isn't it? You can scrap the materials when you even to the point if you knock an old house down and you build a new one, you can scrap the old one.
Mate, 100%. So you just need to get one. This is a double whammy that people miss. They go, oh yeah, we bought a house, we did renos, then we got a depreciation report. You just missed out. You missed out on a massive upfront, because get one before, scrap all the stuff they've already, allocated, and then claim the other stuff going forward. So it's a double whammy.
At what time? I'd be interested in your opinion on this one. At what point would a person who has multiple investment properties be considered in the business of investing in property for further tax deductions in their future?
Yeah, mate. Look, there's a lot of cases on this. There's no number, but you'd have to show that this is your business. Like, as in, if you've got 2 properties, it's not enough. You've got to be, actively. You're managing yourself. You've got 5 or 6 properties. You're managing them. And you're adding to it, and you're in the business of adding value to them and so forth. You've just got to show that it's a business. You're not just a passive investor. It's a real business. So there's more argument for Airbnb, because that's a business. You can say, I'm in the business of renting these out. I'm running the business of an Airbnb. That would classify more as a business. But it's just a question of fact every time. If you've got one property, you're stuffed, but again, if you've got a block of units, well, different story. But passive rental just coming in, no, won't cut it.
You've got to be more active at the back end of it. Yep. Okay.
But we had a client once upon a time, and I'm wondering whether you see this as well in that space, that had an adjustment style property.
Yeah.
And we applied to the ATOs. This is 100% legit, but basically we created a hotel offering for horses, if you will. So say, look, put the offering out to your clients. Have the fact that they're going to put molasses in their food, that you feed them, that you rug them, that you groom them, that you black their hooves, and put different service packages there. And we at that point in time got a sign off from the ATO saying, yep, it's a business, which got him around. Otherwise, it would have been in rental. Is that something that you see and have been working with clients on, or is that?
Yeah, you do. And it's just a question of fact. There's a ruling of all the things that they look at. You don't have to prove them all, but you got to show that these are more likely to be a business than not. And I saw one of the questions on the chat saying, what's the advantages? There's two advantages. When you sell it later and the small business capital gains rollover relief. But number two, claiming motor vehicles and writing them off, like we just talked about the asset write-off. Like that's, if you're in a business, you can claim all those. So yeah, if you're a business, you get access to all these bloody federal government incentives that they've just put out.
You get to write off a few expenses before tax, above the line, below the line.
Yeah. And there's another question there. Way to reduce tax if a client pays in advance for work not yet completed. Yes. That is income. If a client pays you before, yes, you put it to unearned income in the balance sheet, so you don't pay tax on it. Make sure that's massively important. If you're going to get paid up front, then and you haven't done the work, it's a liability in the balance sheet. And then as you do the work, it goes to income. It's your ops. Let's say you did part of it in July and part of it in August, then you allocate it over 2 months.
So that's sort of almost cash basing and accrual-based accounting system. Yeah.
Look, I'd be very pressed for you to argue with me that you're a cash-based business in this market or in this world. Like, if you're in a business, mate, it's very hard to prove that you're a cash-based business. It's accrual accounting, and those that are not are more the PSI income earners, the ones that it's personal services income. It's all there. It's like contracting work. It's one person deriving the income.
Yep.
Does that make sense?
100%.
100%. I'm just having a look what else on the budget to mention to you guys. I looked at it because there was quite a lot of stuff in there that people would not even know about and have missed. And I looked at it before to go, what things could I bring? The pooling of assets and the writing off of assets. That's a big one. Look, all the stuff that Jace will know about, all the first home buyers, the 10,000, Jace, the 10,000, 2% for single mums now and 5% for first home buyers. Look, that's just fuel, just fueling everything coming along.
Mate, rather than trying to push it right now, I can put you on the spot in a different way and say, if next Friday or the Friday after is free and you want to sit down and have a longer conversation that spans across opinions on property, where it's going, what Jace is doing, what we're doing from the budget, from a tax, from a property perspective, mate, I know that the viewers would love it, and we'd love to have it because it's been ages since you and I have got to catch up as well, mate.
Mate, I'm gonna look at my calendar right now, mate. Lock it in, Eddie.
Lock it in. All right. So this is the first time we've actually booked something in on Wealth, Wine and Wisdom.
Very organised. That's good.
Mate, look, I live and breathe this property space, and I have a business, property business, let alone an accounting business. So I've been listening, watching, learning, talking to the best economists, not here, just globally as well. So I'd love to share my thoughts.
So the 4th of June, mate. Are we on for 4 o'clock on the 4th of June? 5 o'clock on the 4th of June.
Lock it in.
I'll send you an email invitation, mate, so that we're in. And I don't want to keep you. Mate, I appreciate the fact that you've spent the time with us tonight. It was us who were late. It was Jason and my fault. It was not Paul's. It was definitely in Jason and my camp. But, mate, I do appreciate the time because I know that that's detracting from your team. But we will look forward to having a deep dive into all things property, tax, budget, business on the 4th, I beg your pardon, 4th of June.
Mate, love to help. Thank you, guys. Enjoy
Awesome.
Enjoy that drive, Jason, that Porsche, and enjoy.
Just make sure that you trade a new one in, mate, so that you can get stung again with the with the non-depreciation limit, but you can also get the 50-odd thousand there. So
mate, I was thinking of giving this one to my missus as well. So, mate, you're giving me some ideas.
Mate, I'm doing the numbers right now. I've got a ute that I've been looking at for a little while.
Crazy.
Don't forget too, Andy.
Thank you, boys.
Thanks, Paul.
See you,
Appreciate
guys.
it, mate.
No worries. Bye-bye.
Thanks, mate.
Thanks, Paul. So, ladies and gents, that's Paul Sidorovsky. He's been a regular for those of you who have tuned in right back from the beginning. Paul was sort of a regular who used to help us dissect what was going on in the world of property and tax and business, and him and the boys at Sidcore Accounting have been really helpful in helping us even mastermind some of the tax strategies that we've been doing.
Yeah.
So really appreciate Paul
mate,
coming on board.
Put the screen back to your full screen. I think it's a bit dodgy at the other end. So just leave your wonderful, beautiful face, mate. It'll be all fine for you.
Well, mate, I'm just going to pull the screen across because I'm blacked out.
Yeah, well, it looks a bit dodgy, but while you're doing that, folks listening in, it is an interesting time when it comes to the world of tax, and some things are changing. Nothing drastic, but certainly, the budget's giving us a little bit to think about. Andy and I were quite excited the other day, a few little ideas, and they're still percolating along. And it was an interesting one, and can you get your wonderful face back, Andy, or is it blown up on us?
Oh, I thought I was back. Hang on.
No.
Yeah, no.
Just try and change your picture around, but it may be at my end potentially.
I think it's on your end, mate. So the viewers, if you can help us out, if you can see my big ugly mug front and center, please put a Andy. We can see your big ugly mug. Or say there is a problem. There is a Houston. We have a problem. You're back here, mate. So thanks, Calvin. Appreciate it.
Beautiful.
And Heidi.
All right.
So we're all good, mate. It's on your end, but we can hear you loud and clear.
Oh, good. Well, I've got a little pop quiz for you, Andy. Folks listening in, you might have seen this one the other day, but on average across the states, by contribution to tax income by the state, the combination of property revenue. So let's talk stamp duty. Let's talk local government rates, fees and charges as a percentage, Andy, and those listening in, as a percentage of income across Australian governments or across Australian state governments. What do you reckon the percentages are across the country, Andy, that the states receive from real estate?
So just to articulate the question again, is how much tax revenue does the government or the state governments receive as part of investment properties?
Properties in totality, not investment, but like the whole property industry when it comes to commercial, residential, land tax, stamp duty, mum and dad stamp duty, home stamp duty, investor stamp duty, whatever it is.
Look, I'm going to go. I've got a ballpark. Hang on. Yeah, I'm going to say about 30%.
Just a bit more than that. 45% on average across Australia. Contribution to total tax revenues, according to the AEC group. This was in Fin Review the other day. And guess what your favourite state, Andy? Guess what your favourite state, the state you live in?
Awesome. Did we punch 50%? Did we?
Yes, you did, 59%. And I think, all right, Deadly Dan and his crew are looking to carve a few more percent out of the coffers by the look of things. It's an interesting one. But the highest state that has the highest in the country is the ACT, actually. And there you go.
Isn't that interesting? The ACT. It always seems to be where the pollies play, isn't it?
Mate.
I reckon that there's probably a significant amount of deductions attached to those at the same time.
Mate, I tell you this, and I've said this to folks before. You know, we joke about, you know, what's the ways we can have a capital gains tax-free property. You know, you can your own homes, capital. If you own property in a super fund after retirement, in retirement phase, you know, capital gains portion. You and I like this one, the capital gains tax-free small business tax concession. What Paul just mentioned, and the other one where you can have capital gains tax-free property, Andy, is you can become a politician actually, and you can have two principal place of residence capital gains tax-free, because you can own one in Canberra and you can own one where you live.
Well, here you go, Jace. That means you and I are starting a small business party, I reckon.
Oh, I'm in, Andy Fenton. Count me in. And I'm actually, it's just I don't know why I haven't thought of this before when I asked Paul, and I've just wondered. I think you and I should sniff this down. At what point could we help our clients, our combination clients from a property investor point of view, sort of my crew, but working with you, turn into a small business property investment business that then qualifies Andy to have a $2 million property sale for their small property business. You know where I'm going with this?
I know where you're going with it, and you're thinking about the active asset side, which would need to be part of the actual business. But what Paul was referring to was the rollover relief, and that is, mate, I'd never thought about that, and that is definitely a strategy that you and I are going to unravel, because
it's like ooh, yes,
yeah, I felt your ears prick up, mate, when he said that. It was like, oh, this has definitely got Jason's attention, and it does mine. And actually, you know what? Even though we only got Paul for a very short period of time today, and that was legitimately Jason and my fault, but that actually goes to show that the A-team concept. So having an A-team of advisors allows you to have, even with the 15, 20 minutes that Paul was on, I reckon I'm percolating with about 15, 20 action items on the back of it, because there's a whole lot of little things that Paul just dropped, even though it was super, super fast, just dropped a whole lot of little nuggets that I, and it looks like you have as well, Jace, just jumped onto and gone, that complements this, and we can work that through. And that's really the benefit of being able to have people who are sharp and on the money with what they do, and are open to listening to other people's areas and opinions and ideas that relate to their area of specialty.
100%. I think it's an exciting bit. Looking forward to catching up with him next week. But mate, what do you got? Anything in the news for this week at your end? I'm driving. I've got one or two little slides here that I've saved for us to chat about a bit later. But you know, what do you got? You got anything for the team, the crew listening in?
Anybody would think that we hadn't prepared for this, Jace.
No, fully prepared.
Well, mate, in the news, let me just bring it up because I accidentally put it back down. In the news, Wine and Wisdom 47, who would believe it? That's almost as old as Jace.
Almost one more.
So we had well, Bitcoin continues to run its turmoil, but I love, you know how I love these headlines, Jace. I love to take the piss out of things a little bit. But 4 hours ago, hundreds of billions of dollars changed hands across derivatives this week, eclipsed activity in the cash market as speculators rushed to close positions. And that was basically saying Bitcoin bubble bursting. Then 7 hours ago, while Bitcoin bounces... While Bitcoin bounces up in a market value like yo-yo, There are real-world applications that utilize the crypto world currency underlying blockchain technology. So that was 7 hours. So that was before the 4 hour talking about the bubble burst. And then right smack bang in the middle, 5 hours in between it, ASX futures were up 0.5% to 7,050. All three benchmarks closed higher on Wall Street after the Federal Reserve released research on the paper of digital currency and shows how that can actually help the globe. Mate, you try and figure out what's happening in between those headlines that were a mere 3 or 4 hours apart by the same people. So this, ladies and gentlemen, is why you've got to be very, very, very careful about what you read, because if you didn't scroll through the whole feed and you only got one of them, well, you were 4 hours away to making a wrong decision. But something that you and I have talked about a fair bit has been value and growth. And you talk about value and growth properties. And so for me, I talk about it as in value and growth shares. So value in the share market, and typically I look at commercial property in the value space going, well, it's something that has very, very steady incomes that underpin the price of the asset. And typically, if it's under what the forward revenue looks like, then it's a value stock and it's of value to you. If the forward multiples, meaning how much you're going to earn each year, turns out to be a very, very low percentage, but the stock keeps rising anyway, it's a growth stock because you're looking at the expansion of the company rather than the ongoing income of the company. So we were talking, Jason, you probably remember about the potential cycling out of growth stocks into value stocks. And so here's the data, which is the most recent stuff that I can find from Canterbury Investment Research Management. This graph is value. So in the blue, and so the very first is the 30th of the 9th, 30th of September, 2020, through to the 30th of May this year is on the far right. So the blue line is value versus growth. So the outperformance or underperformance of value versus growth. And as you can see there, value is pretty much consistently been trending in the upward direction. So when you and I started saying that we can see a bit of a value shift happening,
is this on volume? Is this on volume? What's the? Is this
on performance comparison?
On performance comparison. Okay.
So pure price. So if you had both stocks that were valued at $1 and the value stock went up to $2, then you would see the blue line go upwards really aggressively relative to the other. So it doesn't mean that growth stocks are performing poorly, and it doesn't mean that value stocks are performing positively, just by the by, because it's just the outperformance. So at the moment, we did actually see a big clawback in Wall Street on growth stocks. But I wanted to show you this because this has actually been happening ever since we started talking about it, in that value stocks have started to become more and more appealing, because when the growth journey ends, and the growth journey does end, right? Or it doesn't end, it slows down for a period of time. When the buoyancy is out of the market, because Apple's not going to go to $4 trillion just because people love Apple. There's got to be some price rationale in there. Right? There's got to be some I
don't know about that, Andy, but yes, you're probably right. But
it will end up there, but just not in this cycle. And well, Tesla is one of those stocks which is well beyond what you would really pay for it. But now what we're seeing is, as people start to become a bit scared. When people start to become a bit scared and you're like, oh, the market's overvalued. Are they overvalued? And you're probably hearing sort of things like this in property. When people become scared of stocks becoming overvalued, and in stock world, you can see a 15, 20, 30% correction very quickly, right?
Yes,
in COVID,
it happens fast. Yeah.
We saw 38% in COVID, and it happened within a matter of weeks. So people are starting to become a little bit hesitant and going, maybe the growth has gone a bit too far. So what they look for is companies with really strong cash flow.
Income, yeah.
And because the income's not going away, Jace. In energy, people still have to pay their power bills. People still have to pay their interest rates on their mortgages. People still have to pay for their phone bills in telecommunications. So these companies, people still have to pay for petrol, regardless of what the Saudis are doing.
According to Warren Buffett, men get up every day and shave. That's why he likes Gillette, right? It's income every day.
Well, it's not the man of my household, but the theory.
He doesn't make much money out of me. I'm a bit of a baby face, but it's the income streams that are making sense, isn't it, right now? And it's an interesting conversation, Andy. Like, there's a very similar thing that I was just looking at with my crew the other day, where interest rates, cost of money, cost of the cost of borrowing has plummeted to all-time lows. You and I have chatted about this many times, and now we are getting a yield compression, an affordability/yield compression on property prices right now, because people actually can afford 20% more just because the cost of the money went down. So, but I'm really curious, Eddie. That's one of the things in the back of my mind for all the property investors now. Like, when the money's as low as it's going to get, like, it can't get much lower. The lending can't get much lower, can't get much cheaper. Then that little almost fake mechanism is off the table, right? It's off the table when it comes to manipulation of the property prices. So, I'm going to be very curious. We believe the flight to quality is the answer for property investors when it comes to residential real estate. And then, certainly commercial, industrial, retail, I think will be valued like an income stock. At the end of the day, it's like, what income can I get out of it? Is it stable? Like, that will be worth more. The yield will compress because the cost is less. It's very interesting one. It's happening.
The further it's, for me, it's a purchasing power of economics, right? And this goes back to a conversation you and I had about Tesla. Remember when they had the share split of Tesla? And I said,
yes,
normally when companies go down after a share split, I reckon it's probably going to go up. And the reason why I reckon it's probably going to go up is because we end up with a lot more. There you are. So you pulled over, mate. I'll stop the screen share and we'll just bounce in here. And I said the reason why I think it's going to go up is because it's now affordable. So more people can play. Yeah. Now, the more people that can play is the more irrational manipulation that can happen. The less people that can play, then the less irrational manipulation. It's still irrational manipulation, right? But what tends to happen is you go further up, there are less players up the scale. Now, when Tesla, each share was $1,500 US, not your average punter could go out and just drop $1,500 to buy a single share, right? And that's one share. But when it all of a sudden dropped to 500 because they split it in a third or whatever it was, then everyone's like, well, actually, no, I can get a couple of Telstra shares now. And the volatility went and then went. But what happens is if you've got a whole lot of penny stock investors and the company has a little bit of a tilt, they shit the bed and they're out. Like Bitcoin, 80,000 to bang. And that's an inverse game as to Elon Musk was, and him and his world, big players and lots of small players in the space. Big players, gone. Small players, bang, are out of the market. And it's just another example of how they can play together. Have we lost you, Jace? No, we just lost you.
Did my camera go off? My back. All right. Is that it?
No.
There we go.
There you are. Yep.
It's an interesting one. I call them the good time Charlies in real estate. Well, you get these people who, for some reason thought it was a good idea to invest. Didn't really understand what that meant, and then at the first sign of, their property price didn't double in 1 year like that they were told by some person who was full of it. They cut and run, they dump the property, and they ruin the value of other people's long-term goals, for a year or two, or maybe even longer sometimes. And it's a really interesting one, isn't it? That's the penny stocks get the other person the volatility going, and in real estate, the good time Charlies, jam up the people who were there for a long time. They were building their property portfolio. Yeah, it's an interesting one. They're in every nook and cranny, right?
Well, I had a client of mine, and I promised I'd actually ask you this while I was on tonight, and we sort of won't hold you to it, but I'll give you the background behind it. Not able to go into the super high affluent kind of market, and was looking in and around the Mornington Peninsula. Is just sold on the expectation that maybe things were just going to become a little bit hard after they repealed JobKeeper and stuff like that. Not on my advice, just by the by.
Gee.
And now it's sitting there watching the property market go up. Right now, if you go into $1 million plus territory, so you're down the chain a bit. And I know that sounds like I'm a complete wanker when I say that, but now in Melbourne, $1 million doesn't get you much at all. Right, it doesn't get you jack.
It doesn't get you much in Sydney either. Yeah.
So his question was, Andy, I'm not sure what to do now. Do I just hold out rents and try and time the market, or try and find when the opportunity comes, or do I just have to get back in? And obviously, my response is one of lifestyle. It's like, well, mate, if it's for you, it's for your family. Where you buy and sell is almost irrelevant, because you bought and sold in the same market, and 30 years from now it's going to be up. But that's got to be something that's playing in the psyche of people at this point in time. What would you say to those type of people, knowing that they actually could, if they're getting into the village kind of house and land package that was well overpriced and oversold? What would you be saying if they're kind of in and around, they're not quite sure? How would you treat that conversation?
Yeah, certainly two different conversations when it comes to, is this a forever location? Is this the home? This is where the kids are going to go to school? And it just, other than if you can't afford it, the dollars and cents really don't play into it in the short term. You want to live there, you find the thing you can buy and you buy it, right? But if they're not, I always say to people, if you're not committed to this location, and you're not quite sure, I always say let the money work somewhere else. Let it work in another state or a place or whatever until you're sure, because you can always exit if you want to. I'm not a big fan of selling myself, but it could go to work in a better market, a less expensive market, a market that you could get a better return on, leverage and yield. For 2, 3, 5 years until you're sure, and you can bring it back to, we're gonna buy a better house now. I've got a better job. I've got a better income. That money now I could, borrow better with, something like that. So, it does come down to really that decision.
Actually, you know what, and appreciate that. I'll probably send them around, because if he's not already listening, send you to Jason's team, because I didn't actually think of that in the moment, that perhaps it's sit on the sidelines and of your PPR and become an investor in an area that you can afford, which does show good potential, and at least you're covering both worlds deductively from that perspective. So that was one that I didn't think of in the moment. But I'll pass that on, mate.
And certainly in some cases, in Melbourne, has had less pressure on the rents because of the COVID lockdown and other bits and pieces than other places in the country. Right now, you can actually rent very competitively in Melbourne in comparison to the weekly monthly cost of something decent. So
it's interesting though, because on the streets, I think that the averages are coming out different to the reality at the moment. What we're seeing on the streets at the moment is areas where you and I wouldn't recommend anybody to buy a house, right?
Yeah.
But from income constraints and families and school locations, people are kind of forced into these areas. Some of these areas where you would not buy, you just wouldn't, because it's the same jungle where, and what I mean by that is every third house is exactly the same, and they're 2 inches apart, but it's in an area that if you've bought into the market, you've seen the capital growth, you sell out, and it's kind of like you don't want to buy there. The rents in those places are actually astronomical, and I don't want to mention the sort of suburbs, but where I'm actually seeing this with a few people now, and they're trying to get back. They're almost better to go and bloody live in Toorak and pay a couple of dollars extra. It's just you'll pay probably $50,000 for the school more every year, but we're seeing that dynamic here in Victoria, in that some of those lower socio-economic areas, the rents are proportionately significantly higher.
Yeah, bottom end is, Andy. You're dead right. I was thinking, a 4-bedroom house, it's 1.5 million. You can't afford to buy 1.5 million, but you could probably rent it for $850 a week. You know what I mean? Like that proportionate at that end, but at the bottom end, there's so much competition. For that stuff, it's the one that's getting a little bit more pressure than the other spot, and there is a bit of legislation that's come in, so some of the investors need to be aware of that stuff. Our team have been briefing everyone on the how much they can put their rents up and so on. Victoria, the Victorian government's got in there a little bit. They're just going a little bit socialist as far as I'm concerned. Like they're just
mate. So I switched on the television at the wrong time, and I just had a cold shower, and a few things shrunk even further. And so, mate, tell me what your take is on what's come out. And I know we're sort of hitting time, but mate, the pieces that I heard, and I haven't had a chance to research it, made my skin crawl. So what's your take on it so far? And I know it's really new, but
yeah, it's new, and obviously it hasn't been legislated, but this is the sort of the thing they're going to go after. But increasing the land tax, going after anyone who owns X or Y value properties. Anyone who sells out from sells a piece of raw land for a development, they want an exit fee on a development zoned uplift. So you go, well, yeah, we rezoned it for you, so you need to pay us extra for the rezoning. Like, what the, you
rezoned it 27 months too late because nobody picked up the fucking the zoning permits. You had to pay somebody in there just to have a coffee with them, just so that you could actually get it onto their table. Mate, that's extortion. That's extortion.
It is. It's ludicrous, and it's everyone's up in arms about it. Like I can tell you, like all of my circles, people are like, "This is we're marching on the capital stuff for them." Like it's
that's a Trumpism. Like when Trump basically said, if we're going to stop TikTok from being able to operate in the US, then we're going to broker a sale between TikTok China and Microsoft at the time was one of the front runners. Donald Trump's like, well, we want a fee for that. Like that is extortion, like that, and that's not government's place to be doing that. That's ludicrous.
No, it's crazy, mate. Yeah, and then in the rental space, there's some proposals and changes. So certain areas and certain properties you can only increase the rent, a certain amount each year, limiting it to $10 a year or whatever it might be. So there are going to be some challenges in that space. And my team's been pulling it apart a little bit. Thankfully, when you are purchasing in certain areas and certain qualities and styles of property, that's not as impactful as potentially
it's just
some of
like
those places.
There's less people playing there. There's more. There's less people creating hysteria. Hysteria happens in the masses, not in the minority, which is probably, as you say, that flight to quality. Long term is just going to protect you against the volatility of hysteria. It could be really interesting, mate. That's a really good theme, I think, that we should be watching moving forward.
Mate, yeah.
And maybe buying some land in a country that won't turn into Little China. That's very contentious for me to say. The Socialist Republic of Victoria.
Andy for president. Oh, premier.
Oh, can you imagine it?
Well, mate,
there's a lot to dissect.
As smooth it wasn't as smooth as we normally do it today, but it was certainly valuable. I got a couple of very curious ideas chatting to Paul, and hopefully people listening in were interested as well. It's good that you booked us in for a longer chat with everyone.
Well, mate, wanted to do that with Paul because there hasn't been a huge amount of change, but there's been enough change for us to really, have a long conversation without constraints and let everyone hear the thought patterns that go through somebody who's a professional business thinking accountant. And between the three of us, like, we're all trying to think of new ways of doing it. We don't always think of the best ways, but we're always looking for what is the relationship that all of these different changes mean to each other and to our clients. And I think a longer conversation in and around that will be really beneficial for me and probably yourself and everybody who listens.
Yeah, right.
So even though it was short and sharp and you were on the way somewhere, it shows that we can be nimble and accommodate progress. But mate, I know that you've got to get somewhere tonight. Just in the 30 seconds wrap up, just to answer Jason's question, if you thought that was valuable and super keen to hear more, give us a thumbs up, give us some light ups on either the thumbs or the text comments in there. We would love to see you. I know that Calvin, James, Alison, as always, has been super active in there. Was Paul's talk recorded? I missed it. No, because we don't want to get sued. Just joking. Are these recorded on your channels? They are. They're part of a podcast.
Yeah, they go live. Yep, they go live. Team, gang listening in. So if you go, I don't know when we finish this, I think you can go back and watch it after it's processed. Again, so either in the Facebook page, the YouTube channel, or the mentoring group. So and also on the Fenton pages as well. So
and where all good podcasts are found, you can find Wealth, Wine and Wisdom episode 47 as a podcast. So if you ever miss it, you can listen to it in the car like Jason was today and catch up on all that was from the past. But
Spotify or iTunes.
Well, mate, I'll let you get on with the weekend. Thank you, everyone, for being a part of it. It was great, and it was great that you didn't cancel, given you had other commitments, mate. That's the dedication to the cause. And although we couldn't shoot the breeze as per normal, and here's the funny thing, mate, is I actually had you pegged in to do some real work after our conversation tonight. So you've managed to slip out of that, but I'll try and catch you next week. But as always, we appreciate you guys listening, and we love to give as much as we possibly can from our weeks. And as long as you continue to interact with us and continue to get value from what we bring to you, we are going to continue to bring more. We do have coming up in the not too distant future, I didn't tell you, Jace, still waiting on a response, but one of the head of supply chains for Pacific Advisory and Transactional Services in Industrial and Logistics, it's a mouthful of a title, is going to be coming soon, Miss Miller or Mrs. Miller. Hasn't confirmed yet, but she is an incredible wealth of knowledge in supply chain logistics, which is becoming a theme. But we'll continue to bring people like Paul, like Jason, like Mrs. Miller, who you'll hear from in the not too distant future. But mate, unless there's anything else on your side of the equation for tonight,
mate, it's good night from him,
and it's good night from me. We'll see you all next week.
Thanks, gang.